So today let's talk about margin call. These two words can actually destroy billionaires as well as billions overnight. And why it happens is because of leverage. We'll understand how and why leverage is used, how it can be beneficial for the investors, and how it can be disastrous. Right? So, why every investor fear these words is not a random thing. There are plenty of instances and reasons why this word is so feared of. Right? Let's look at some of them. Of course, the 2008 financial crisis, the 2021 Archegos collapse, and even daily. This is not something that you hear only when there is a financial crisis, but this word could appear in anyone's asset management app or portfolio management app whenever there is leverage that is being used without knowledge and discipline, right? So what happened in 2008 was basically margin calls accelerated the financial crisis by forcing mass liquidation across the global markets. In the case of Archegos collapse, one single family basically lost billions overnight. Banks were demanding collateral that in the first place never existed. And this was basically one of the history's largest trading losses. Every day, investors could receive a notification forcing them to either sell your assets immediately or basically added more cash. We'll understand the process, how it works. There's no negotiation, no delay, and no excuses involved in this. If a margin call comes, you have two options. Either you liquidate your assets or you add in more funds. There is nothing in between. I know this might not be clear right now, but slowly and gradually we'll be able to understand how and exactly this process works. And what the scary part is, it can destroy beginners of obviously, but billionaires as well. See, in any process, in any investment, in anything that you are doing, if you don't have the knowledge, professionalism, and the discipline to do that, anything could be as dangerous as it could be, right? The only thing when you have to study about margin call comes back to the equity ratio, right? So let's understand how basically leverage works. So talking about margin in margin call, margin is nothing else but borrowed money for investing. Now, what's the problem in it? Or maybe the gain in it? See, you have 1 lakh rupees with you, but you look at the market situation and you want a position in the market worth 2 lakh rupees. Now, how would that 1 lakh difference be with you, right? So, this 1 lakh basically you can either borrow from your broker or any bank, right? Now, margin simply means borrowing money to buy investments. Suppose you have 1 lakh of your own capital and want a exposure to 2 lakh worth of stocks. Your broker basically lends you the remaining 1 lakh, and this basically is called leverage. So your total capital plus the broker loan that you took is basically ultimately your total position. Simplified like this, right? Now, why does it exist? Just like businesses need funds to grow, corporations borrow to expand, investors borrow just to increase their market exposure, right? If these borrowed funds are used responsibly, leverage improves the capital efficiency. It could help you benefit from the capital that you don't have, right? So we have this situation in mind. Let's say your stock rises 10%, right? The 10% is basically 20,000 rupees of gain, right? Now, the market return was actually 10%, but because you only put 1 lakh rupees of your capital in the market, this is basically your gain. But because you took a broker loan as well, maybe there could be some interest that could be charged, maybe that amount could be anything, right? So adjusted those price, this is your gain. Investors is able to gain approximately 20 minus the interest. Leverage basically double the gain. See, market rose 10%, but your return is basically 20%, right? So this is why leverage is used, and this is how it can improve your capital efficiency, right? But again, leverage works both ways. Now the same 2 lakh position, let's imagine, falls by 10%. But the problem is that market fell by 10%, you lost 20%. But this 20% is your own money only. See, this is something that you can forgo, but this is something that bank or the broker at the end of the day or the end of the period would definitely ask back. So because this 20% gain was being showcased in from your 1 lakh rupees, same would happen for the loss. The 10% decrease in market led to 20% loss in your investment, right? The broker would still want its 1 lakh rupees back. So this 20,000 of loss is actually borne by only and only you, right? See what happens. You had 2 lakh rupees, loan amount keeps 1 lakh rupees, right? Your equity is 1 lakh rupees. Now what happened after the 10% fall? The total portfolio became 180. The loan remained the same. This is unchanged no matter what. Neither in loss, neither on gain. It remains constant. This 80,000 is reflected in your equity, right? So equity is basically total assets, that is portfolio value here minus the loan amount. This is your equity. Now now we'll talk about the margin call. So what is margin call basically? See, margin call is the demand from your broker to either deposit the money or reduce your position. This means basically selling your assets, right? So what happens is there's a maintenance margin that is being mandated in the contract, right? When you ask your borrower or your broker for your loan, right? Now broker requires investors to maintain a minimum level of equity, typically 25% of the total position value. Total position value was 2 lakh, right? So equity value should be typically, see, it varies across platforms or brokers or banks, but a typical 25% is what we consider. If your equity value drops below or at 25%, you will get a margin call, right? This 25% of the total position value is called maintenance margin, and it is decided before entering into a contract, right? But you have entered a contract, you have borrowed your, you have leveraged your position in the market. If that falls below the maintenance margin, there would be a single warning, no negotiation, no extension. The broker will liquidate your position if you don't act. After you don't act, no warnings, no negotiation, no extension. Simple, as simple as that. Your first option is to deposit the cash to restore your equity amount. The second option is you liquidate your position. A margin call is not a punishment, it's a risk management tool which brokers are protecting their loans. Right? Now, That is where margin call basically exponentially tries to create or amplify a financial crisis, right? So price falls, what will happen? Your margin call would be triggered. You would be forced to sell if you don't add additional capital. If you by chance add in more capital and if the more prices decline, there would be more margin calls. Again, if that value reaches to 25% of your total portfolio value, your equity falls below 25% of the total position in the market, there would be more margin calls. This loops keep on repeating. This is what looks like in a crash market. This is one of the most dangerous feedback loops in finance. Each round of forced selling pushes price even lower, which triggers new margin calls, creating a self-enforcing spiral that can wipe out billions in market value within hours. See, why more prices decline? This is very important thing. When you are selling, when you are forced to sell and you fail to add in capital, what happens is no one is willing to buy. No one is willing to buy, but you are forced to sell. So it increases the number of sellers in the market but low number of buyers. This is what creates that people are willing to sell but no one is willing to buy. This is basically pulling the price even further down, right? Now we'll understand about the systematic impact of it in the entire system. How margin call becomes systematic. See, modern finance is heavily interconnected. When everyone borrows simultaneously, small market declines can become systematic events. See, there are two types of events: systematic events or unsystematic events. Systematic risk or unsystematic risk. Systematic risk is a risk that affects everyone in the market, right? Unsystematic risk could be because of a particular situation in one particular company. Unsystematic risk is a risk that cannot be diversified. That can be diversified. I'm sorry. Unsystematic risk can be diversified, but systematic risk, because it is affecting the entire market, you cannot diversify it. What happens is when everyone uses leverage, banks use leverage to amplify the lending and the trading operations. Hedge funds use leverage to magnify their returns on complex strategies. Investors are using margins to increase market exposure beyond their capital. How they do that is MTF, that is marginal trading facility, right? This is how they can get their capital and have a leverage position, right? Now let's talk about the domino effect. Let's say one fund gets called, they are forced to sell their holdings. Again, because of this, the prices further drop, so more funds get called. A margin call affecting one institution can eventually impact many others. This is called a systematic risk, a risk that one failure cascades through the entire interconnected systems, right? Now, talking about Archegos Capital, what happened here? See, what Archegos was doing, they had enormous hidden leverage through the total return swaps. Now, what total return swaps are, I'll tell you on a surface level understanding. Let's say there's a deal, and in that deal, banks are said to buy a particular stock. If that particular stock rises, what will happen is that gains would be transferred to that company who made that deal, and the bank would be given a fees in form of maybe an interest. But if the prices fall and there is a loss, bank would immediately trigger a margin call asking the person to bring in more liquidity in form of equity, right? So when the stock declines, concentrate its position in a handful of stocks. What Archegos did, they concentrated on mainly, I guess, two stocks, and when both of them began falling sharply, banks demanded additional collateral. Margin calls arrived rapidly, but the problem was Archegos couldn't meet the demands, forced, and it basically forced liquidation and eventually wiped out billions because banks were asking for money that never existed in the first place. So, see, underlying stock decline wasn't the real disaster here. The stocks are meant to fall up and down, but because of such an enormous hidden leverage through the total return swaps, this was ultimately the tool that led to that decline. Right? Archegos proved that excessive leverage can turn manageable losses into catastrophic collapses, even for sophisticated institutional investors. Right? So, margin is basically a tool. The problem is misuse. See, if you're gaining, everything feels good, everything feels perfect at its place. But obviously, it feels uncomfortable when the position is going against you. Right? It's not like nobody is using them and nobody is gaining from it. Professional traders are using leverage for capital efficiency. Market makers are people who make sure there is enough liquidity present in the economy, in the stock markets. They regularly purchase and sell stock so that potential buyers and sellers are always available in the market. Institutions use leverage to hedge risk, right? So leverage is basically everywhere. Leverage is more accessible than ever. Option trading apps on options trading on every app is available. Future contracts with low margins are available. Margin accounts with one click are available. Retail investors can now take risks that were once reserved for professionals. But where is the problem? Accessibility is the problem. When there comes greater access to something, there comes greater responsibility for that particular thing. Understanding margin calls is very important than ever because of greater access, right? The same tool that built fortunes has destroyed them as well. Again, how to make sure you don't suffer? It's knowledge and discipline plus professionalism. This, if you are keeping and having knowledge about them, if you are disciplined in your approach, and you are a professional who knows why he is doing that and what will happen, and have proper hedging mechanisms to take care of that disaster, you are doing good. It's not something that could be considered a game. It is a matter of billions and millions of dollars, right? It can, see, margin call have the capacity to reduce your positions in a more exponential manner, right? So leverage helps in magnifying gains, but it also magnifies losses. You have to use it responsibly. It can be useful in that particular manner, but when it is abused, it turns small declines. See, remember the 10-20% thing. 10% market fell and your loss was 20%. This turns into a financial disaster. The most dangerous risk in finance is often not the asset you buy, it's the money you borrowed to buy it. If you have access to borrowing a capital or anything else, you should understand how loss can be magnified due to that borrowed capital. Right? Thank you.